John, you actually wrote a column earlier this week noting the bond market reaction, apparently in part to Nancy Pelosi's visit. But do you think it has longer-term ramifications?
I fear it has very much greater longer-term ramifications, and I'm a little concerned both how quickly the bond market got worried. We had a brief period of not much more than 24 hours when there was really quite intense demand for treasuries born on the classic desire for a safe haven, and more or less as soon as Nancy Pelosi's plane had landed in Taiwan without the Chinese trying to shoot it down, I'm only slightly exaggerating, the market rebounded as though everything was okay, and certainly the degree of saber rattling we're seeing at present from China is quite concerning. It's conceivable that this speaker's trip has in some way called China's bluff. I'm not a military strategist, but plenty of people are pointing out that Taiwan is an island 100 miles away from China. It will make, Russia couldn't make a good job of invading Ukraine. China actively invading Taiwan is going to be orders of magnitude harder. So whether arguably the risk of a total breakdown, a return to conflict is still quite slim. But there's no question. If this leads to a serious worsening in US-Chinese relations from where they are now, or, which we must all hope not, outright conflict, that's very serious. That's any way you look at it, that's going to be bad.
Mona, what about your perspective? And not just limited to China. We have an awful lot of geopolitics going on, as John just referred to briefly in various respects. Do you think geopolitics is affecting the markets right now, or do they have enough to worry about, whether it's inflation or whether it's supply chains or whether it's the Fed?
Yeah, David, this year we actually got an outsized amount of geopolitics impacting markets directly, of course, starting with that Russia-Ukraine conflict, which not only kind of exacerbated the inflationary problems, but really put upward pressure on oil, energy, grain prices across the globe. And then, of course, we did shift some focus to China, but because of the lockdowns and the on and off lockdowns created tensions in supply chain, created some demand reopening and then shutting down once again. And then, of course, with Nancy Pelosi's trip this week, we started to think about maybe another tail risk emerging in geopolitics, which is the China-Taiwan situation, which could potentially, at least in an investor's mind, could be a Russia-Ukraine 2.0. And keep in mind, the implications would be quite a bit more severe. Supply chains and inflationary pressures, again, could be exacerbated to even more extreme levels. So for now, in our view, we think it's a tail risk, but certainly one that's worth monitoring, and certainly one that we're watching could intensify in headlines if we see, another similar type of trip, negotiation, discussion. But hopefully for now, a tail risk that has a lower probability than certainly what we saw in Russia and Ukraine.
So Mona, translate it into some investment advice, if you would here. Does that mean if I'm an investor for my portfolio, I should look at more defensive investments, whether that's equities or debt? Stay away from growth right now?
Yeah, I think in the near term, so look, we've had a great run, rebound off the lows of mid-June across equity markets and even in fixed income. So in equities, we've seen the S&P rally nearly 13%. Underneath the surface, the growth parts of the market, technology, et cetera, are up nearly 20%. Similarly, fixed income rebounded off lows as well. Now, going forward, if we start to see yields move higher, we've had a really nice move downward in yields, but keep in mind, we still have the Fed in play. We still have quantitative tightening in play, which could put upward pressure in yields. If that occurs, we could probably once again see growth start to underperform or lag again. So in our view, as we get through the next few months, as those earnings and economic data perhaps start to soften, catch up with what we've seen in equity markets earlier this year, we would advise a more defensive tilt, value-oriented defensive sectors in equities and fixed income. But if and when we do get inflation kind of in earnest moving lower, the Fed in earnest able to pause, that's really when we see a pickup in risk assets, but perhaps a shift towards growth once again. And that's when you'd start layering in and barbelling growth. But for now, we'd say stay invested, stay perhaps somewhat defensive in the months ahead. But don't be surprised if earnings and economics bottom. Start to bottom, but equities look forward and start to move higher. So that's what we do expect to happen, a U-shaped recovery ahead.
So John, just overly simplistic here, briefly, does that mean I should have more bonds than I thought I should?
That is a very difficult one. I tend to be somewhat bearish on bonds. I think that there is a risk that the peak for the 10-year rate isn't in yet. And that means that you probably don't want to pile too heavily into bonds. My best guess, because all of us have to contend with the fact that we don't really know the lack of good precedents for what happened to the world in 2020 means that there is also a lack of good precedents for what we should be expecting now. My best guess is that rates probably have to rise higher to choke off inflation. The rule of thumb is that inflation doesn't go down, doesn't peak until the interest rate exceeds the inflation rate. That implies that we're going to be going, I would say, above 4% at least. And that would mean that you would want to be getting into more defensive kinds of stocks that actually benefit from higher rates, which, as Mona said, is basically value. If you want it in terms of tail risk, there's this Machiavellian possibility of getting into chip makers that aren't from Taiwan. If something bad happens there, then there can suddenly be a lot more scarcity of chips.